A life of financial freedom, time flexibility, and the ability to work anywhere? Sounds amazing, doesn't it? This is the dream many envision when they first step into the world of Forex. Picture yourself sitting by the beach, sipping your morning coffee, armed only with a laptop and internet connection, effortlessly making money. It feels perfect, simple, and irresistibly attractive. But does reality play out this way? When you first enter the market, the initial excitement quickly gives way to confusion as you face price fluctuations. The thrill of seeing your first profitable trade often turns into disappointment when the market moves against your expectations. Moreover, natural emotions like greed, fear, doubt, and hope frequently trap traders in a loop of losses. The Forex market, or any financial market for that matter, is like a sophisticated trap designed to exploit human emotions. We fear being wrong, dread losses, and find comfort in following the crowd. Unfortunately, these tendencies often lead to consistent losses. Have you ever wondered why you frequently buy high and sell low, even though theory always advises the opposite: buy low, sell high? Consider this scenario. When the market is in a downturn, negative news is everywhere, and people panic sell, driving prices down sharply. Instead of seeing this as an opportunity, most of us hesitate, afraid to buy. Then, when the market starts to rally, positive news emerges, and people around us boast of their profits. We jump in, hoping to claim a share of the gains. The result? We buy at the highest prices and often get stuck when the market corrects. The emotions of exuberance from small wins and despair from significant losses create a never-ending cycle. Initially, we celebrate a few small wins, but when the market reverses and moves against our trades, we hesitate to cut losses, fearing to admit mistakes. Instead, we hope for a price recovery to break even. As the market continues to fall, the fear of further losses grows, and we sell at the bottom, cementing our losses. To break this cycle, the first key is risk management. A wise trader always enters trades with a risk level they can accept. This level not only helps maintain composure, but also reduces psychological pressure when the market moves against predictions. More importantly, you must learn to think and act contrary to your natural instincts. For example, instead of following the crowd, train yourself to observe the market with a cool head and logical analysis. When the market drops sharply and everyone is panic selling, ask yourself, is this a good buying opportunity? Conversely, when prices have risen too high, instead of chasing profits, ask, is the risk worth continuing here? To achieve this stable mindset, you must first understand and recognize your emotions. Only when you can name them, greed, fear, excitement, can you begin to control and overcome them. This requires consistent practice, not only in trading skills, but also in emotional regulation. Forex isn't an easy path to wealth, but it's an incredible journey to learn how to control emotions, manage risks, and develop decisive thinking. This foundation brings you closer to the financial freedom and time flexibility you've always dreamed of. Investing sounds exciting, but when emotions control your actions, it becomes a risky journey. One of the most common emotions traders experience is hope. At the start, everyone dreams of big profits, financial freedom, and the satisfaction of beating the market. But think about it. Does hope truly help you achieve these goals, or is it a sweet trap leading you into a cycle of losses? Imagine placing a buy order without setting a stop loss. What's your mindset at that moment? Hope. You hope prices will rise and deliver the profits you desire. Perhaps the market complies initially. Prices rise, you make money, and your faith in hope grows stronger. However, problems arise when prices don't climb immediately, but instead fall or stagnate. Rather than pausing to analyze, You reassure yourself, it's okay, prices will bounce back, just be patient. This time, prices may not recover as expected, but instead continue to drop. At this point, hope morphs into fear. How much further will prices fall? Should I cut my losses? Yet you convince yourself it'll rebound, just like before. Instead of making decisive moves, you spiral deeper into emotional turmoil. The more prices fall, the more your account burns, yet you can't seem to pull yourself out. Why? Because hope has transformed into a dangerous habit, a psychological trap preventing logical decision-making. How is hope different from a goal? One important thing to understand is that hope and goals are not the same. Goals motivate you, help you build a plan, and guide specific actions toward achieving clear results. Hope, on the other hand, is often a vague wish for a positive outcome without any grounded plan of action. For example, when you place a buy order, if you set a specific goal, including stop loss, take profit points, and adherence to risk management principles, you have a solid foundation to act with discipline. However, if you rely solely on hope, it's easy to neglect fundamental rules. When prices drop, instead of cutting losses, you continue hoping the market will rebound, which often leads to significant losses. Why is hope dangerous? The danger of hope lies in its ability to create an illusion of safety. When the market rebounds and brings profits, it strengthens the belief that hope works. But in reality, you're relying on luck rather than a sustainable trading strategy. All it takes is one instance where the market moves completely against you without rebounding to dismantle everything you've built. Remember, hope is not a strategy. Trading is a game of probabilities and risk management. Betting on hope is like playing a game of cards without a plan. Ultimately, the cost will always outweigh the gains. Greed, the dangerous companion of hope. After hope, greed is another emotion that every trader must face. Initially, the feeling of fast and big profits from a few small wins can lead to overconfidence, making you want to increase your trade size to earn more. But when greed takes over, you begin to disregard risk management rules. Instead of adhering to appropriate risk levels, you increase your trade size drastically. Why? Because you want to win big and win fast. However, this is like racing against your emotions, and the moment the market moves against you, everything can collapse in an instant. This explains why many traders with high win rates still end up losing everything. All significant loss can wipe out all previous profits and capital. How to escape the emotional trap? Determine an appropriate risk level, whether you trade with $10, $50, or $500. Ensure the risk amount does not affect your emotions or decisions. A suitable risk level is one where you don't feel the need to constantly check your account. Eliminate hope, build goals. Instead of hoping the market will move in your favor, set specific goals for each trade, including entry points, exit points, and risk/reward ratios. Accept losses as part of the game. Every loss is a lesson. What matters isn't how much you lose, but what you learn from it to improve future trades. Keep your emotions steady. Remember, the market doesn't care about your emotions. Trading is effective only when you separate emotions from decisions. Trading is not an easy path, but if you can control your emotions and apply the right principles, it can open doors to achieving the financial freedom you dream of. Let hope and greed control you. Let discipline guide you. Greed leads you into the trap of unrealistic expectations. When you increase your investment size, the hope for larger profits often skews your perception of the market. You tend to focus on the potential for prices to move in your favor while overlooking the risks if prices move against you. This not only heightens the pressure during trading, but also leads to a common mistake: changing your take-profit plan. Imagine you enter a buy trade with a take profit level set at 1.5R, a reasonable profit target based on your statistical win rate. When prices hit your target, you happily close the trade. But then, the market continues to rise, and you start feeling regretful. What if I had held on longer? This feeling prompts you to change your behavior in the next trade. You decide to increase your profit target to 5R, believing greater profits await. But reality often disappoints. Prices may only reach 2R before reversing, turning what could have been a profitable trade into a loss. The issue doesn't lie with the market, but with how greed causes you to deviate from your original plan. To avoid this, rely on statistical data to set a reasonable take profit level instead of following your emotions. Remember, the higher the profit target, the lower the win rate. For example, at a 1R profit level, the win rate might be 55%. At 2R, the win rate could drop to 45%. At 3R, it might fall to 35%. At 5R, it might fall to 15%. Rather than chasing unrealistic expectations, choose a profit level that aligns with your win rate to ensure a long-term trading edge. Fear, the aftermath of significant losses. If greed drives you to overextend your expectations, fear emerges as a reaction to substantial losses. Fear manifests when each trade becomes a source of anxiety, making you overly cautious, hesitant to enter trades, or inclined to close trades prematurely. Imagine experiencing several significant losses due to not setting stop losses or aiming too high. Now, every new trade fills you with worry. Will I lose again this time? This fear leads to counterproductive behaviors. Hesitating to enter trades, you miss good opportunities out of fear of losing. Closing trades too early. You exit trades for small profits, thinking a little profit is better than nothing. At first glance, these actions may seem reasonable, but over time they don't lead to sustainable profits. In trading, long-term profitability doesn't come from winning many small trades, but from optimizing the risk/reward ratio. If you keep closing trades too early, you'll fall into the trap of small wins, big losses, where your gains aren't sufficient to cover your losses. How to escape the emotional trap? Accept risk from the start. Before entering a trade, determine the amount of money you're willing to lose without it affecting your mental state. This reduces the pressure of trading. Stick to your take-profit plan. Don't let regret over past trades cause you to alter your plan mid-trade. Use statistical data to set reasonable take-profit levels and stay disciplined. Don't let big losses shake your confidence. Losses are an inevitable part of trading. What matters is learning from them and improving rather than letting fear dictate your actions. Build discipline. Emotions are the greatest enemy in trading. Discipline and statistical data are your tools to overcome them. Let discipline guide you. Don't let emotions ruin your journey toward financial freedom. In trading, a high win rate doesn't always equal profitability. This is a lesson most of us only learn after experiencing significant losses. At first glance, winning 7 out of 10 trades might seem like an excellent outcome. But if each winning trade only brings in $2 to $5, while each losing trade costs you $10, then despite the impressive win rate, the end result is still a loss. This is a common psychological trap that many traders fall into when entering the market. The big mistake: cutting profits too early, letting losses run. Take a moment to reflect. How many times have you felt regret for not holding on to a trade longer when the price continued to rise after your take profit point? This regret often leads to a change in your original plan. Next time, you decide to hold the trade longer, expecting higher profits, but then the price doesn't move as you hoped and starts to reverse. The result? Small wins can't compensate for large losses. On the flip side, when prices move against your trade, the hope that they will recover often prevents you from cutting losses in time. Such losing trades not only wipe out small gains, but can also jeopardize your entire account. This behavior is a dangerous mix of greed, hope, and regret, factors that undermine trading discipline. Why you shouldn't change plans based on a few recent trades. Another common mistake is letting emotions be influenced by the outcome of a few recent trades. For example, if you repeatedly see prices only reach 0.5R or 0.8R before reversing to hit your stop loss, you might feel compelled to take profits earlier than planned. However, the reality is that the outcome of a few trades doesn't reflect the bigger picture. Trading is based on probabilities, and you can only make informed decisions after analyzing statistics from a large number of trades. Changing your plan due to a few losses is equivalent to sabotaging your strategy. The market doesn't follow your emotions, and luck is not a determining factor for success. The only thing you need to do is stick to the plan and the proven methods. Understanding true account growth. Account growth never follows a straight line. It resembles a fluctuating chart. -1R, -1R, -2R, +2R, +3R, and so on. There will be periods of consecutive losses, but these will be followed by significant wins that cover the losses and generate long-term profits. The focus shouldn't be on how many trades you win, but rather how much you win relative to the risk taken. If you maintain discipline and adhere to your strategy, profits will come sustainably. Emotions, whether fear or greed, will only serve to derail your progress. How to trade correctly and overcome emotions. Set clear rules and follow them, regardless of whether your previous trade was a win or a loss. If the entry criteria are met, place the trade without hesitation. Let data, not emotions, guide your decisions. Don't let regret influence you. Instead of regretting missed opportunities or losses, focus on executing your plan correctly. A loss that follows your rules is still a good trade. Analyze long-term statistics. Trading is a probability game, not about short-term results. Only statistics from tens or hundreds of trades will give you a true picture of your strategy. Focus on the big picture. Don't let a short losing streak destroy your confidence. Long-term profits come from consistency, not luck. Remember this mantra. A stop loss triggered on a rule-following trade is better than a profit earned from breaking the rules. Why? Because consistency in discipline and methodology is the foundation of survival and success in the market. Act with the long-term picture in mind, not based on short-term emotions. This is the only way to achieve sustainable growth and turn trading into a path toward true financial freedom.